think it's more a conversational piece about subject matter experts talking about where are we at, what's the journey been, and just really giving their insights.
I think, having probably Sarah kind of describe the situation would be a good angle.
I mean, the interesting thing that came up, I think, from the call we had with the group was I said, can I ask you, for example, what kind of products might have conflict minerals? And the answer was, what products don't have conflict minerals?
Well, when you hear the term conflict minerals, you just have to know that that is tin, tantalum, tungsten, and gold. Regardless of where it originated from, at least under this rulemaking that the SEC just did, those four minerals are known as conflict minerals. The term comes because they're primarily sourced from, well, not primarily, but can be sourced from the Democratic Republic of Congo and the adjoining countries where there's been a lot of ongoing conflict, violence, and these minerals have been a source of funding for the armed groups in that region.
What exactly is the rule going to require companies to do, just at a high level?
Companies are going to have to identify whether they have any of those four conflict minerals contained in a product that they manufacture. And if that mineral is necessary to the functionality of that product, they're going to have to do some special reporting to the SEC on an annual basis.
Every electronics company is going to be impacted. Tin or gold is in practically every electronics product, and electronics have kind of in most of our products, aerospace, automotive, industrial products.
But I think it really impacts many, many other industries, like an industry which you don't really think about, if you look into those four minerals, is the apparel and footwear industry. For example, zippers is something that has some elements of tin in there. And the rules are really very comprehensive. It really doesn't matter how much of that mineral you use in your products. If it's in your products, you will fall under the rules.
Even if it's just the tiniest little bit.
This is not a very easy rule to implement. Maybe the objective is good, but the implementation will be very difficult. It's not a new issue. I think sustainable supply chain is something that industry is looking into themselves already for many, many years. But that was always on a voluntary basis, and you could report on that also on a voluntary basis as well. I think what's unique about this rule is now it becomes mandatory.
So is there anybody who would look at this and say it's an opportunity?
Suppliers that handle this well, so a contract manufacturer that actually handles this well and builds a conflict-free supply chain and makes it easier on the product companies, what we call OEMs, that make it easier, that service will be valuable.
There is a way to differentiate yourself in the marketplace by being, leading the charge and saying, look, our products are 100% conflict-free. The first ones that can do that maybe will have an advantage and will be viewed as, at least by a segment of the population as, preferential.
It's a unique issue. It relates to a human right issue. It's not really a financial issue, what you would expect to see in a financial report.
This is really building off the IFRS final report. What are some of the key takeaways?
I'd like to see the conversation around what do you guys think is going to happen, given the unique perspectives that each one of you bring.
It's always difficult to make predictions, but I think it's safe to say that nothing will happen in 2012. There's no chance that the Commission would vote this year to propose IFRS into the U.S. market.
When you say, there's no burning platform right now for a change in the U.S., so maybe let's get into a little bit about what the staff found as part of their diligence in performing the research as part of the work plan.
To answer your question, I'll start with what the work plan or the final report on the work plan did not say, and that probably has elicited more discussion than what it did say. It did not have any recommendation for the commissioners as to how, when, if to move forward. It did not talk about the next steps. That lack of clarity around next steps really has elicited a lot of discussion.
picking up on political issues, certainly the non-decision was interpreted by some internationally as negative. I guess what's your sense on the impact to IFRS globally by the U.S., not taking any current action?
I guess a couple of thoughts I have on that one, Josh, is one of the things I would hate to see happen is for IFRS to, I'll call it almost implode or become where more jurisdictions say, well, geez, if the United States is not getting in, we're going to create our own version of IFRS. I think, as while there's a lot of issues in terms of whether the U.S. should adopt it, I think we should never lose sight the fact that IFRS has been very, very beneficial for the market, and including the American market, because again, Americans buy trillions of dollars of companies that trade over in Europe. So it's very important to us. If you look at what it was, 12, 13 years ago or 10 years ago, and you have like 25, 26 different accounting standards throughout Europe, and Americans are investing in those companies, it has gone a long way to improve financial reporting and to have one consistent basis throughout Europe.
Yeah, absolutely. I certainly would say this has not been a fool's errand at all. I mean, we said before, if you take a picture of the global reporting and accounting frameworks that existed 10 years ago, it was all over the place.
So where does this leave U.S. domestic companies?
I always look at the issue as a cost benefit, because there is clearly a benefit, at least a conceptual benefit, of having every company around the globe using the same set of standards. But the question really is that incremental benefit worth the cost in this current environment?
I think that's a great point, and a lot of the work that was done at the SEC around the work plan looked at that cost benefit, and a lot of the feedback received was it's a monumental task.
There is a concern, certainly an appropriate concern, that giving up the ability to make your own standards from an accounting standpoint is a scary thing.
To that point, David, it's funny, I've always viewed this whole issue of sovereignty as being really the only issue. I don't think there's any doubt that Congress would have an interest if the Commission were to basically say they are going to defer the standard setting to the private sector to a group outside of the United States. Congress likes to have that oversight, if you would, make sure that the Commission's has its oversight job. I think it'd be much, much different. I don't say it couldn't be achieved, but it'd be much different if they were implementing IFRS.
The underlying theme is cross-border transactions are increasing.
Right.
And that is driving this whole comparability issue. From an M&A perspective, my clients just want one common language to speak about their transactions, be it acquisitions, be it disposals, be it capital raising exercises. It would make their lives a lot easier, right? That still causes a lot of stress in the M&A world.
Do you think there's going to be any pressures built up where people kind of get fed up with the inefficiencies?
I mean, candidly, Josh, we haven't seen that the last decade or so, right? So I don't expect to see it anytime soon.
Is IFRS a priority or focus of individuals within the deal space?
Is IFRS itself a priority? Probably not. Is deal execution a priority in relation to getting deals done smoothly, efficiently, accurately? That is clearly a priority.
The globe continuing to focus more on IFRS, do you think we're at a disadvantage in the U.S.?
Because of the U.S.'s sheer size, right? The U.S. is always going to be a prominent global player from an M&A standpoint. So I think that clunkiness, right, will exist both ways because there's going to be inbound, outbound transactions that take place.
Yeah.
And the U.S. is still a massive capital markets and a massive source of M&A activity, again, both on the inbound and outbound standpoint.
Right.
So I don't think so, because again, there's going to be constantly folks looking to do business with U.S. entities.
The FASB and the ISB have been working for a number of years on convergence efforts. The big three projects, as people like to refer to them, revenue, leasing and financial instruments. You know, a lot of work has gone in, especially over the last 3 years. And we're kind of getting to the point where we're starting to maybe see the light at the end of the tunnel, possibly for some of these projects. Give us kind of a brief overview of where we're at today with the leasing project.
There have really been some remarkable changes in the standard, whether it be how you deal with contingent rental payments and the measurement of a right-to-use asset or liability, or how you deal with defining the lease term. The boards have really done a nice job listening to the concerns of constituents in terms of making the ongoing accounting model a little more operational and a little easier to manage.
It also probably makes it easier for those that are very well informed in general but don't live in the weeds of the technical nuances to better understand the area. The current leasing model has a lot of gotchas in it, and those gotchas cause us to follow certain accounting approaches that may not be intuitive to your general informed analyst. And so from that perspective, I think we're moving the bar in terms of in the positive direction.
And the benefits will be a more substantive or a better reflection of the economics within the financials, you think?
I think the benefit is anytime you have a form-driven standard, you run the risk that you aren't allowed to exercise judgment about what's the most appropriate presentation for a transaction because the considerations you have to evaluate are laid out before you. One of the advantages of looking to the economic substance, irrespective of form, is it allows the people closest to the transaction to really make a firm judgment about what's the most appropriate accounting model to use and to exercise a bit of professional judgment.
Right.
And if we all do that in a high-quality way, I think that is a plus for financial reporting overall.
So, John, maybe switching over to financial instruments a bit. You know, some of the main benefits either, you know, prepare perspective, investors, analysts.
Whenever you move from multiple models for measurement classification driven off of form-based distinctions to one model, I think you inherently create a more understandable approach. And, you know, regardless of the arguable deficiencies that people might observe in the proposal, the one good thing is in both classification of measurement and impairment, they are attempting to come up with a consistent model that would be applied to all financial assets, debt security, you know, fixed income type financial assets.
What are the things that companies need to be focused on that they're not currently focused on, do you think? Or the questions that they should be asking, but maybe they're not?
For non-financial services companies that have portfolios of debt investments, today's impairment model for debt investments is trigger-based. You don't have to automatically start applying an impairment model to an acquired debt security. You only start evaluating that issue if an event happens that causes the value to fall below its carrying value. And that's understood by non-financial services companies and maybe arguably easier to apply. Now, all companies will have to apply an impairment model immediately. And non-financial services companies are not used to that. They don't have systems in place to automatically start applying, a loan reserve kind of accounting model. And so I suspect that will be an area of challenge for our non-financial services companies.
That we're going to have a relatively lengthy transition on this. That's absolutely true. But I also think you're going to need every bit of that time because the only people in your organization talking about this is the finance function. I would first start to say, okay, IT department, some of the other folks in the organization that are going to be affected by this, HR, some of the other departments, you at least want to start working on the awareness within your organization.